Welcome, everyone. My name is Manny Ortiz. I'm a managing partner at Occidental Asset Management, and I'm joined by James Griffin, another one of our wonderful partners at the firm. Thanks for taking a few minutes today as we go through our mid-year market update and five themes that are kind of shaping the rest of 2026. The short version is we remain very constructive on the economy and the markets, but the margin of error has narrowed.
That's right, Manny. Yeah, the market, as all of you've seen, has rewarded broad optimism over the last couple of years, especially around AI trade and mega cap technology. But as we've kind of moved towards the second half of the year in 2026, things are becoming what appears to be a little more selective. So our goals today is to walk through those five themes that we're watching and explain what that might mean for your portfolios.
Yes, I guess the better question is the market going up or down? The better question is, where are earnings, cash flow, and valuations supported by fundamentals? So with that, let's just kind of get started with our first theme. And this is kind of our framework for the second half of the year. There are five connected themes: AI spending versus AI returns, inflation and interest rates, consumer resilience, earnings quality, and market leadership.
Yeah, so all five themes are really asking a version of the same question. So, is the return investors are receiving backed by real cash flow, real earnings, and real economic strength?
You know, to me, a lot of that matters, right? And it's because markets can tolerate a certain amount of uncertainty when fundamentals are strong, but when valuations are high, interest rates are elevated, and investors are paying close attention to cash flow, the details matter a lot more.
So, kind of like less like driving down a wide open highway, which we don't see a whole lot of those here in Central Florida, and more like driving through a construction zone. So, you can still make progress going through a construction zone, but you have to pay a little more attention to the lanes, the guy holding the sign to stop or slow, and then the speed limits along the way.
Yeah, so let's just jump right into the first theme, which is AI, right? It's been the biggest theme over the last few years. And the big takeaway here is the AI story is not over, at least not in our view. Cloud growth remains super strong across all the major providers. AI infrastructure demand is still very robust. Companies are starting to show productivity gains, and revenue tied to AI adoption continues to accelerate.
Yeah, I think really the questions changed. So a year or two ago, investors were rewarding, anything connected to AI, whether it be picks and shovels or software end. But today they're asking a harder question, and it's really when does all this spending turn into profits and free cash flow to investors?
Yeah, that's really the distinction, right? AI has moved from this exciting concept to more of an intensive capital build out. And companies are spending a lot on chips and servers and data centers and power. And we think the opportunity is still there, but the market's becoming a lot more disciplined about what to pick and when.
So, me, I like to use analogies, and my son Nathan wanted to start a lemonade stand recently. And so, we went out and we had a table and we bought some lemons and sugar and cups and then he was asking about, making a special sign and putting some advertisements out. And I was like, Nate, let's get to selling a couple of glasses of lemonade before we, start investing in SEO and everything else related to that. So what's the return on this investment, buddy? Let's make some cash flow before we, put $5,000 into SEO.
Yeah. And we saw that if we look at the slide, a great example is Google, right? It hit record earnings, but the stock fell because AI capital expenditure pushed free cash flow to negative territory. Tesla saw a similar negative reaction, where rising capital expenditures without clear free cash flow support, right? The support of that free cash flow, and then that became the concern.
So the takeaway is not necessarily that AI is a bubble. The AI infrastructure demand is real. Picks and shovels side of the market still has demand, but investors are increasingly focused on whether that spending is going to create durable margins and reoccurring revenue. and the cash flow corresponding to that.
Yeah, and that's really it, right? Owning AI exposure is no longer enough, right? The market is separating companies that can monetize artificial intelligence from those that are simply spending on it, right? That connects directly to our next theme, which is interest rates, where when money's expensive, the market becomes less forgiving, right? And we've seen that over the course of history. And spending doesn't produce visible returns. So as we kind of look into our next theme for the second half of the year, which is inflation, interest rates, and the Fed, we've seen that inflation is moderating, but long-term rates and geopolitical tensions are complicating the path forward, right? The slide shows on the headline CPI posted its biggest single month drop since April 2020, and core components show encouraging signs, including super core services dipping negative.
So that does give the Fed some room, but the important distinction is that Fed has more direct control over the short term end of the interest rate curve more than the long term. So right now, though, the long term edge of the curve is where the pressure is showing up. 30-year Treasury yield is above 5%, which is the highest it's been since 2007.
Yeah, and long-term rates really matter because it hits four major parts of the economy at once, right? It hits stock valuations, it hits mortgage rates, it hits consumer borrowing, it hits corporate financing costs. It's all turning up in a gravity of the financial system, right? Everything can still move, but it just takes more effort, right? You need more grease on those wheels to keep the train moving.
For sure. I think a big component of that is energy, in which we're watching that. Obviously, oil and geopolitical tension has been moving quickly. Higher fuel costs as it relates to what people are paying at the pump can make a big difference into household budgets. Obviously, folks on the lower end of the income curve are going to be greater impact by those increased expenses. But that flushes its way through a lot of areas in the market. It's really hard to find products that don't have the use of oil or petroleum in it.
Yeah.
Um, yeah,
Yeah, what I'll say is like, and this is again another takeaway, markets can handle moderate inflation, right? That it's built around it. Most businesses are built around some level of price increase over time. What markets struggle with is a renewed rise in long-term rates, right? Because that directly affects valuations.
yeah. I mean, obviously, you'd rather have moderate inflation than deflation. But I think that the practical message is simple. We're not saying that inflation is out of control. We're saying that the path is narrower. Stable energy prices and easing inflation would definitely help the economy globally. But if oil prices rise, long-term rates continue to move higher, that puts pressure on stocks, housing, and credit.
Yeah. So at the end of this, the Fed matters, but the consumer matters too, which brings us to our third theme, which is the consumer and the economic resilience of that consumer. The consumer has been super resilient and way more resilient than many expected. We've seen retail sales hit 760-ish billion dollars as of May 2026, which is right around 7% year over year. In the slide, you can see there's no recession signals, although consumers are becoming more selective.
Yeah, the last phrase is important there. Consumers are not necessarily spending less across the board, but they're spending more carefully.
Mhm.
Which we saw that recently with some sales coming out here with emails. I don't know if you saw that as well. Social media, everyone's got a
Yeah,
sale. But
everybody.
they're prioritizing essentials, value, right? Experiences, while becoming more selective around discretionary categories. Some of the upper ending costing items.
I mean, it really comes down to labor, right? And labor is the foundation of the market. So as long as people have jobs and there's income, people will spend. That doesn't mean that every household feels strong, but it means the economy can absorb stress as long as employment holds up.
Yeah, so I like to think of the consumer like the engine in a car, right? The engine still running. May have a few warning lights, which are worth looking at. Fuel costs are a little higher, borrowing costs are higher. Discretionary categories can soften first. So you may postpone that, restoration hardware couch or that new Wi-Fi enabled refrigerator, but you're not going to postpone groceries, commuting, household expenditures, education, those sorts of things.
Yeah, we love those restoration household couches. They're nice and plush and expensive. Those are really, really nice. So this slide really flags three things that we should be aware of, right? Number one is the labor market. Number two is the fuel costs, and the third one is rate pressure. So higher gas prices tends to squeeze lower income households, and higher borrowing costs affect autos and mortgages and credit.
At the same time, there's some households that have been more insulated, maybe dual incomes, maybe appreciated assets like their house and their stock accounts. They have lower fixed long-term mortgage rates. So it's definitely an uneven consumer environment. They're talking about this K-shaped economy. So some households are still spending while others are making tougher choices today.
Yeah. And I guess, again, the takeaway from this is what should we watch in the second half of this year? And our answer to that question is jobs. As long as employment remains healthy, as the consumer can adjust, right? The consumer always has the ability to adjust. If job losses rise in a significant way, then that stress becomes harder to absorb across the economy. And that really leads us to corporate earnings, right? So as we look at corporate earnings, on the surface, earnings look pretty strong. On this slide, you can see that about 85% of the S&P 500 has beat estimates in the second quarter of 2026. And again, on the surface, that sounds great, and in many ways it is. But in this environment, we need to look beneath the headline number.
Yeah. So an earnings beat by itself doesn't tell the whole story. Earnings, investors want to know the earnings where they're coming from. Is it from the core operations, from free cash flows, from durable margins? And so whether they're, boosted by a one-time gain or just an accounting item as well.
Yeah, so if you're ever driving down a nice neighborhood or any neighborhood and you see a beautiful house and it can have great curb appeal, it may have fresh paint, the landscaping looks good, it overall looks pretty attractive. Before you buy it, you still want to have an inspection, right? You want to make sure that foundation is good, the roof is good, the electrical is good, the plumbing is good.
Yeah, you got to watch out for that cast iron.
Yeah.
Yeah, I would say with the earnings foundation is margin quality, cash flow, repeatability. On the bright side, S&P 500 gross profit margins today sit around 39%, which has been increasing year over year since 2022, and I'd say it's a very encouraging sign.
Yeah, but it also highlights some red flags, right? So if we look at Google, 87% of its earnings came from investment gains. A negative free cash flow is appearing at some of the mega cap companies. We saw that at Meta yesterday, right? Meta released earnings yesterday and they absolutely got hammered for their AI CapEx spending. And for Google specifically, one-time gains can inflate reported earnings per share, and the market's becoming more selective.
Yeah. Yeah, and to be clear, the point is not that anything improper is happening with Google, but that the earnings, aren't all created equal. So in a more selective market, investors want quality earnings, not just accounting earnings.
Yeah. And one last thing I would highlight on this slide is that it shows expected EPS, earnings per share growth of around 47 to 48% for information technology, about 67.5 for energy, 28% for communication services, and about 25% for the S&P overall.
Yeah, takes some juice to run those data centers. So, I mean, I think this tells us that there's still areas of strength in the economy. It reinforces that need to be selective. Strong headline earnings are helpful, but investors should pay attention to where those earnings are coming from and whether they are repeatable.
Yeah, and that kind of leads us to our fifth theme, right, which is leadership and rotation. If the market becomes more selective, leadership won't necessarily look the same as it did in 23 and 24. So, what does a healthy bull market look like? Well, it typically broadens out over time, and we're seeing some signs of that, right? This slide points to small caps outperforming, healthcare leadership expanding, and broader sector participation beyond a handful of mega cap names, right? The Mag 7. And we've seen that dominate in 23 and 24 in those years of rallies.
Yeah. I mean, we always love a portfolio that's broadening and it's encouraging to see. So if you own a diversified portfolio, you don't want just five or six, seven names doing all the heavy lifting, but you want a good contribution from like a larger majority of positions in the account for sure.
Yeah, and I feel like we do a really good job here at Occidental of putting our clients in positions where they're broadly diversified across many of the different sectors. And diversification is really it really earns its keep, right? In the walkthrough, we talked about developed international markets being up about 9.5% year to date compared to the US large cap at about 9%. We also talked about US value being up almost 19%, while US growth in aggregate was flat for the year.
That seems like a meaningful rotation, right?
Sounds like it, yeah.
Yeah. So it's not the market is not just about one theme, one sector, or just a handful of names. It's definitely a larger list there.
Yeah, but there's also risk, right? So you'll see that 17 of the 30 worst performing S&P 500 stocks year to date are actually software companies. As as we kind of look at artificial intelligence, it's being viewed more of a direct threat to some legacy software business models.
Yeah, so not random volatility, it's a structural shift in where people see future value. If software is sold by the seat and AI can do some of that work those seats use to support, then that growth math changes. So it'll be interesting to see how that pans out. A stock being
Mhm.
down 40% does not automatically make it cheap if the business model itself is under pressure.
Yeah, and that's a huge distinction, right? So cyclical weakness can be a buying opportunity, but structural disruption is completely different. The market's separating winners from losers more aggressively this year than in recent years, and that argues for a broader diversification, not less. So, why don't we let James bring it home?
Yeah, and I think that active management, to an extent, not day trading, but some form of active management tilts makes sense in this market as you're starting to see some changes there. Um, we think that the weight of evidence is still constructive. The margin for error is narrowed a little bit. So on the positive side, there's no recessionary signal from leading in models that we use. Earnings growth remains strong. Corporate profit margins are high. Market leadership is broadening, and AI and fiscal stimulus remain particularly tailwinds.
Yeah, and on the risk side, we're watching oil prices, we're watching 30-year Treasury above 5%. We're watching some fatigue with artificial intelligence CapEx spending. We're watching the consumer getting some pressure from fuel and borrowing costs. And obviously, we have barely touched on this, but we have midterm elections here in a few
Yeah,
months.
yeah, you get those text messages here soon.
Oh yeah,
Yep. So balance is exactly how we're thinking about portfolios. We're not saying investors should get out of stocks. We're not saying investors should be deliberate about what they own and how they own it. That's what we think we should
yeah,
be thinking about right now.
yeah. Three takeaways from this slide. Number one, uh, stay invested, right? And more than anything, stay invested, have a plan. It's super important. Number two, there's no recession signals at the moment. And lastly, as we look at earnings growth, they remain the primary driver of long-term returns.
Yep. Prioritize quality, right? In this environment, free cash flow matters more than
Yeah.
just the reported earnings per share.
Yeah, and diversification matters, right? Concentration in a narrow group of stocks and winners. We see it all the time. Clients have had huge concentration and run up in certain names. It creates opportunities across different sectors.
Yeah. So from an investor perspective, this could be a good time to revisit the portfolio if you haven't looked under the hood recently. Now's a good time to make sure your holdings still match your plan, your risk tolerance, and what environment we're in.
Yeah, and as a reminder, here at Occidental Asset Management, we are fiduciaries, which means we have to look out for you and your best interest. And our focus is aligning your portfolios with your broader financial plan. So the second half of 2026 offers a great opportunity, but it also requires a lot of discipline. We appreciate you for joining us today, and we hope that you keep joining us moving forward. If you have any questions, comments, or concerns, feel free to reach out to us, and we're here for you. Thanks, everyone.
Thanks, everyone.